makers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, in a moment, we'll talk markets with Anwiti Bahuguna from Northern Trust Asset Management. But first, the latest on President Donald Trump's international diplomacy. Now, a day ago, the U.S. and China announced a breakthrough in talks, with both sides temporarily slashing tariffs. Now, in the last hour, President Trump landed in the Saudi Arabian capital of Riyadh as he begins his three-day Middle East tour. In the first major international trip of his term, Trump is also visiting Qatar and the United Arab Emirates. Now, let's head straight to Rosalind Matheson, Bloomberg's EMEA news director. So, Ros, we've already heard from Scott Bessent, but what's on the president's agenda today?
Well, the first thing that's really on his agenda is about investment. As you were just saying, he's going there with a clear goal to extract further investment from Saudi Arabia, but also he's going, as you say, to Qatar and the UAE. And so what he wants to do is get a lot of pledges for investment, for companies to push production, to push money into the US. He's taking a bunch of CEOs with him on this trip. We can see already from this investment forum in Saudi Arabia this morning, there's a bunch of financial CEOs there speaking, tech CEOs. So it's going to be a lot of talk about money and investing in the US. The trick is going to be to work out in all of that pledges about money, what's real, what's tangible, what's coming and when, because you can tote it up and it sounds like a lot. And obviously Saudi Arabia has an incentive to make it sound like a lot. But tangibly, what's it going to mean for companies and for investment and for the US economy?
But so the dynamic is that they both need investment from each other. So they need money going from one place to the other. But there's also, of course, the energy complex, because President Trump was pretty harsh on Saudi Arabia a couple of days after inauguration.
Well, that's right. And obviously oil is a topic, no doubt, for conversation. We saw, his arrival already in Riyadh. Very warm welcome on the tarmac with the Saudi Arabian Crown Prince, the de facto leader, a handshake, very much in contrast to the previous administration of Joe Biden. But as you say, Donald Trump also does want something from Saudi Arabia. And you can see that MBS, as he's known, really gets that message around oil. Lower oil prices, that's what Donald Trump is really pushing. You can see that Saudi Arabia, they can work out that that's in their best interests, at least for now, when it comes to their messaging on production and so on. And so clearly there's an incentive for both of them to give each other a bit about what they want.
Yeah, everyone's talking about, of course, this $500 million plane from Qatar that he would offer the President of the United States. This is in the old Air Force One. Is there a fallout from that? I mean, I know there's domestically in the U.S. a fallout, but what's being talked about in the Middle East?
Well, obviously, there's probably a bit of how did Qatar manage to work this out? Because, giving Donald Trump, or as he would say, it's a donation to the Defense Department. And Donald Trump has said this is not a plane that he would continue to use after his presidency. But it's a very, very extravagant gift, as you would say, even if it needs a retrofit to make it, up to scratch on the security side to be Air Force One. But he's obviously been eyeing this plane for a while. He has admired this plane for a long time. And Qatar, obviously very wisely, reading the room on that. I mean, it's supposed to be part of a broader announcement around Boeing and so on in general. But it is a plane that Donald Trump has been very keen on. Yeah,
you could say it's quite a coup, actually, from the Qataris. Now, to talk markets, let's also bring Anwiti Bahuguna, Chief Investment Officer at Global Asset Allocation at Northern Trust Asset Management. Thank you for joining us. I mean, there's just a lot going on. There's trade deals left, right, and center, reprieves for 90 days. What are you expecting to see in Saudi Arabia? Does it give you, I guess, more of a calmer sense for the markets? The president of the U.S. does want deals.
Yes, thank you for having me, Francine. It's very much in line with what we have been seeing for the last 2 or 3 weeks, in terms of April starting out with fireworks and then steady de-escalation for the last 2 to 3 weeks. So very much in line with that. As you mentioned, there'll be more deals. Both sides want something from each other. But the timeline for those investments to show up in growth and inflation numbers is really long and unknown. So really not much coming out of this for the markets to grab onto immediately, but just to see what the amounts are, how long it'll take, what does it mean for the U.S. economy, not really clear yet from the meetings alone.
But, and it's very difficult, I think, to try and understand who, the president's friends and foes are. Because China, presumably on paper, got a better deal than the UK, actually. And then yesterday he was quite friendly towards China. So how do the markets interpret this?
So the markets are really breathing a sigh of relief, Francine, mainly because the initial salvo with China was just so debilitating for the markets to digest. Very much as Secretary Bessent himself said, it was essentially an embargo on trade. So that de-escalation does imply that the worst-case scenario is off the table. But by no means is this really good news for the U.S. economy or for the global economy. So if you think about it, the weighted average tariffs U.S. had before Trump administration 2.0 started were somewhere in the range of 2.5% to 3%. Now we have de-escalated to north of 10%. That's not necessarily good for growth or inflation. It is good in the sense that it's not the worst case, but it is still a degradation of conditions from where we were before these tariffs were imposed. So that keeps us fairly cautious on where things might end up.
Roz, what did you learn about the U.S.-China relationship this week?
As Anwiti was saying, it's sort of, you see the narrative changing very quickly. Productive conversations, warm relations, and, Trump even saying, well, I might talk to Xi Jinping in the next couple of days. Of course, China being very careful in response to all of that. But it's very clear from looking under the hood of this deal that the US, in a sense, had to use a lot of its leverage to get something done. And China got pretty much all of what it was looking for on reciprocal tariffs and a point person to deal with going forward. And, as we were just saying, there's still a lot of tariffs going on here. Yeah. But for China, it was probably the best outcome. And for the US, what exactly did they get out of it? And so you can see other countries looking and saying, hang on, so if you play hardball, maybe you can also get what you want.
Ross, do we have a better understanding of what President Trump wants at the end of the day? Is it, money coming in because of tariffs, or is it actually negotiation? Is it deals? Is it what's he after?
He's just after something. He can go to the American people and companies and markets and say, look, I've delivered something for you. And it's all about that overarching narrative of having to show that he, is bringing money into the US, he's bringing jobs into the US. Does it actually have to materialize in the end? It's a bit like the Saudi Arabian investment idea. Again, very long tail, tangibly we don't know, but it sounds good. And that's the most important thing, is to show the American people he's making good to some extent on the things he promised he'd do.
So, Anwiti, in this kind of environment, how do you invest? If you look at, treasuries, dollar, we have this inflation print today that I know investors will be poring over to see what the Fed does next.
Sure. I think it is a trickier environment for investments, for sure. So I have been thinking about that a little bit more in the long term, that we've had almost a decade of massive inflows into the U.S., into U.S. equities, into U.S. treasuries, into U.S. Currencies, across all those asset classes. And to a large extent, we have seen valuations really rise in the U.S. markets, particularly in the growth-oriented part of the U.S. market. And last year, for the first time, we began to see a rotation, Francine, out of the growth trade into the value trade. And what I'm hoping for is that that rotation continues, not just within the U.S., but internationally also. So one of the good things of this rally of the last sort of 3 weeks is that if investors were not yet on that trade, this is actually time to start getting defensive in the portfolios. In other words, to rotate out of growth, rotate out of dominant U.S. trades into more broad-based equities, and actually start investing internationally also. So we have an overweight on U.S. on developed ex-U.S. markets. Okay. And I think that's where I would focus right now.
And when you look at the earnings season, I know it was very difficult to see any kind of forward guidance because of all these trade concerns, and you don't really know where they settle. Is there anything in there that you thought interesting that would be, useful for investing or de-investing?
I think, you're very right to focus on the forward piece and not on the backward, because the backward piece was really, really good, much better than the markets anticipated. But a lot of the companies came out again and again to emphasize that this trade noise needs to settle down for them to actually give any guidance on where things might head. So we really didn't see a lot of downgrades either, because it's too early to downgrade or upgrade anything as the noise of the trade is still continuing.
Rosa, we heard from Scott Bessent earlier. He was really quite, harsh, as the president was, on the EU, saying they don't really know they're negotiating with because there are so many views.
Well, that's the reality of the EU. I mean, we saw the new German Chancellor, Friedrich Merz, when he spoke with Donald Trump, said, I had to keep reminding Donald Trump, you can't do bilateral trade deals with Europe because we are an entity, and that's a bunch of countries negotiating collectively through Brussels. So you can't pick them off and do individual trade deals. I mean, that makes it more complex, but also the reality is that makes the EU a much more powerful economic bloc to be negotiating with Donald Trump. Arguably, it's easier to get a UK trade deal. I mean, you've got a trade surplus, less complicated. The EU is a much bigger economic entity, and with all those complexities, because you do have to get agreement between Germany, France, Italy, Hungary, you name it, on how to present themselves to the US. And they've taken quite a strong stance. They've laid out, these are all the things we will do potentially in retaliation, and that makes it much more complex. You can see on the one hand, they're saying, oh, they're being difficult, they're being whatever. Slight sense of maybe admiration coming alongside that. So maybe they will respect the fact that they're getting that strong commentary from the EU. We'll see if the China playbook there kind of works as well for the EU. It's a bit too early to say.
So interesting. Thank you both, of course, for joining us. Bloomberg's Ross Matheson and Anwiti Bahuguna from Northern Trust. Now, coming up, is the U.S. destined to enter recession? Our next guest has been taking a glass half empty approach. We'll look at whether the U.S.-China trade deal has changed his view. This is Bloomberg. The conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacqua here in London. Now, U.S. President Donald Trump says he could attend negotiations between Ukraine and Russia this week in Turkey.
I think you may have a good result out of the Thursday meeting in Turkey between Russia and Ukraine. And I believe the two leaders were going to be there. I was thinking about flying over. I don't know where I'm going to be on Thursday. I've got so many meetings. But I was thinking about actually flying over there. There's a possibility of it, I guess, if I think things can happen. But I would fly there if I thought it would be helpful.
Let's bring in Bloomberg's Ollie Crook, who's at the European Council in Brussels. So, Ollie, could Donald Trump actually move the needle on ending the war? And what's Russia's position so far?
Well, listen, that's his hope. And listen, this is a sort of evolution of a sort of diplomacy process that began over the weekend with Friedrich Merz, Emmanuel Macron, Keir Starmer, all in Kyiv talking to President Volodymyr Zelensky, also talking to Donald Trump on the phone, and really coming to a proposal, sort of ultimatum to Vladimir Putin over the weekend, saying, listen, we want a 30-day ceasefire beginning on Monday to begin to have the groundwork and the conditions to negotiate peace. Putin, for his part, basically rebuffed that and said, listen, instead of that, why don't we have high-level negotiations on Thursday? To which immediately Volodymyr Zelensky, the president of Ukraine, said, listen, great, I will be in Turkey on Thursday. I'm there. I'm ready to have those discussions with you and to see basically what the Russians will say. Since then, the Russians have not said anything. They have not said whether or not they will engage at any level with the Ukrainians in Turkey on Thursday. As you heard from Donald Trump, he's optimistic that potentially something could happen there. And I think that Trump would certainly take that opportunity to go there if those discussions were to happen. But again, I think it is very difficult to envision a world in which Putin arrives on Thursday in Turkey to have those discussions. But as far as the sort of U.S. approach to all of this, this is all part of the U.S. approach to push both Ukraine and Russia to the negotiating table, basically putting more and more proposals forward to figure out who is going to say no. And the sort of lesson that Volodymyr Zelensky learned from the Oval Office visit is that he is never going to be the one to say no. He never wants to be seen as the obstacle for peace. So whenever the Trump administration throws something out, he says, yes, I agree, I'll be there. And now we wait for Vladimir Putin to see whether or not he is going to consent to that. The question is, if we get a no from Putin, will that be enough for basically the United States to say that Russia is the obstacle to peace? Would that be enough to prompt the U.S. to basically more sanctions on the Russians? We know that there is a bill that is now with the Senate being drafted by Lindsey Graham that has these so-called bone-crushing sanctions on Russia that Lindsey Graham has referred to. I don't know that this will be necessarily the point at which the United States decides to put more sanctions on Russia, but this is where the sort of conversation is going, and this is where the United States wants to push both sides.
All European finance ministers meeting today following the U.S.-China trade deal. This is what President Trump had to say about the EU.
The European Union, they were the toughest of all. They were nasty. And I see that. I see that with trade, too. European Union is in many ways nastier than China. Okay? And we've just started with them. Oh, they'll come down a lot. You watch. We have all the cards. They treated us very unfairly.
I mean, is he talking about negotiations, trade deals?
Yeah, so this is what's very interesting, Francine, is that was in a press conference about the pharmaceutical industry within the United States, where they're trying to bring drug prices down in the U.S. But it seems that the Trump administration still wants to preserve some of the profits for those pharma companies, saying that basically he wants them to charge more abroad, to charge more within the European Union. And this speaks to the heart of the difficulty of these negotiations between the EU and the United States. The EU has centralized its negotiating power on trade at the Commission level, but it seems like the Trump administration wants to get a lot of extract a lot of different concessions from the EU that are not necessarily the EU Commission's mandate. So this is the difficulty of these conversations when the Trump administration is mixing trade with non-trade issues, and that is where we're seeming to have issues between communication with the Commission and the United States.
Always communication issues. Ollie, thank you so much. Oliver Crook there in Brussels. Now, a growing number of companies financed by private lenders are showing signs of stress. That's according to first quarter results from business development companies which lend to SMEs. Now, market watchers say that trend is likely to be exacerbated by the global trade war. Let's bring in Robert Dafforn, Chief Investment Officer of Opportunistic Credit at Polus Capital Management. Robert, thank you so much for joining us. Look, you're in an exciting space. If you get it right, if you're not, it's a really hard space. Yep. But you've been extremely cautious actually in finding deals. Now, this was mainly due to the uncertainty because of trade. Are you any wiser onto where we're headed? And what does that mean for you finding deals?
So we're not any wiser. And I think what really matters is the perspective we come at the world from, which is we do a very specific type of private credit, which is we're really buying stressed and distressed credit. So we're actually looking for those negative events to have happened. And we also have another practice, which is taking short positions against businesses we don't think will make it. So it's with that we actually would say, look, we're really seeing from a medium-term investment perspective a continued deterioration in the outlook. I don't think the kind of yesterday and the outcomes would really change your medium-term investment view. There is a weaker growth and somewhat stickier inflation outlook, which is very difficult for levered companies to deal with. We may just have passed from it being a very acute shock of that kind of, sudden stop from a supply chain issue to more of a chronic, but ultimately more sustainable, drawn-out tariff issue.
So, Robert, do you see more distress coming? You basically need then a very distressed, environment to pick up deals. Yeah. What would be the catalyst for that?
Well, actually, default rates have been rising steadily over the recent quarters. So the seeds are already sown in many ways for that. If what we know is that we were coming off a 15-year period of extremely low default rates. And ultimately that means we haven't had the usual house clearing that we do require. If you then take that, you sort of add to that, well, we had higher sub-investment grade corporate debt to GDP than we've ever had before. It became very mainstream from a niche asset class. And then what do levered companies like the least? They hate lower growth and they hate high financing costs. And the longer that is in place, that time under tension is really creating the issues. And we've actually just seen default rates steadily pick up over the last few quarters, and I would expect that to continue.
But, Rob, why has the house not been cleared? It's actually, mind-boggling if you look at interest rates going from 0.5%, 1% to 5%, the space in which they have. Yeah. And nothing really being broken. Is money changing? Is too much money in private hands where you don't see stress?
There's a couple of things. That's one of them. I think the key is the duration of time that you've got bad business conditions. So it's not about the first day that interest rates rise. It's about kind of living in those conditions of, let's call it slightly soggier global growth, but with those still meaningful financing costs, we then get through refinancing cycle, the maturity wall. We're going through at the moment very expensive working capital build, we know from inventory cycles, etc. And all of these things do add up over time. They have to accumulate, though. It doesn't all fall over at the first moment. You have to let it kind of marinate to some extent. And it has been marinating now for a couple of years, which is why it's all the more attractive. But, it is true. Part of it has been offset a little bit by the very, very vociferous lending markets that we've seen. There is a lot of liquidity out there and it has stretched a bit. But ultimately, that is what we'll be looking out for whether the coming slowdown becomes a recession, will be the impact of lower lending growth.
And you were in the U.S., right, for the first time last year. Is there anything more to be done? I mean, the U.S. versus Europe, Europe versus rest of the world. Where do you see opportunities?
Well, I think on the long side, we do really like Europe, but more from a microeconomic perspective, which is it's a massive banking market. There's a lot of kind of, let's call it barriers to entry via languages and legal jurisdictions, which do mean that kind of ultimate slight immaturity of the market is very attractive. But I think the short side is all US. We definitely see higher levels of debt per unit cash flow over there, a much higher incidence of really weak triple C corporates and single B minus corporates. So there are that kind of, I would say the US is the place where there is the most productive kind of short strategy.
So will you be very active in the US? Or moderately?
Well, not on the long side, because it's a slightly more mature market. I think we have a niche in Europe, but we have a CLO business that we're growing in the US that's really aiming to kind of capture the opportunity that we have if we do see wider spreads in the future.
Grow by how much?
Well, we're raising capital at the moment for a sort of several $billion increase in AUM in our US CLO business.
Where do you see? I mean, are there sectors that you see specific stress or that you think will be? I mean, we always talk about, of course, real estate and commercial real estate, and we've seen a couple of things blow out here and there. Is there anything else you're looking at?
Yeah, absolutely. I mean, there's various different industrial sectors which are just struggling from the cyclical conditions. So we've not seen much restocking in chemicals, so that's certainly a struggling sector. Packaging, paper and packaging, highly cyclical. Struggling in building materials because of the weaker housing cycle. There's actually like a number of different sectors. I think we also find very, very attractive is consumer discretionary exposure at the moment. There's a few shocks coming along, now that we see the drag from student loan payments coming out of paychecks again, maybe an end to mortgage forbearance in the United States, along with kind of declining real incomes that we do foresee ahead, certainly because of ultimate tariff implementation. I think consumer discretionary is going to be a very, very exciting place to look.
Rob, thank you so much for joining us. That was Robert Dafforn there, Chief Investment Officer of Opportunistic Credit at Polus Capital Management. Coming up, UK pension funds agree a new deal to invest more at home. We'll get the details next with the Lord Mayor of London and the Chief Executive of one of the pension funds, Phoenix Group. That's next, and this is Bloomberg. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. The U.S. President Donald Trump arrives in Saudi Arabia with hopes of securing up to $1 trillion worth of investments. China lifts a ban on Boeing following the breakthrough in trade talks with the U.S. Plus, UK pension funds agree to invest at least 5% of their assets in UK private markets, a win for the Prime Minister Keir Starmer's Labour government. Now, more on that story, and the UK Chancellor, Rachel Reeves, says she hopes the deal will unlock billions of pounds for infrastructure projects and local startups, while she won't rule out mandating funds to invest.
We don't need to mandate them if people are willing to sign a voluntary accord. And today we've shown that that is possible, with 17 businesses representing 90% of active savers signing up voluntarily to this. The challenge up until now has been that no company wants to go first.
Well, I couldn't be more happy to be joined by Alastair King, the Lord Mayor of the City of London, and Andy Briggs, Chief Executive of Phoenix Group, one of the pension funds that signed up to the so-called Mansion House Accord. So, gentlemen, thank you so much for joining us. Lord Mayor, do you have an estimate, first of all, of how much of a lift, actually, the policy could bring to either the London Stock Exchange, the AIM, or in general the City of London?
I think we've been talking about the possibility of an extra 50 billion pounds coming into the United Kingdom economy over the course of the next between now and 2030, which I think is a really meaningful amount. The amount going into the AIM market and the Aquis, that's still to be determined. It's up to the individual pension schemes to work out how much they want to put in there. But I think 50 billion into United Kingdom plus a further 50 billion worldwide, I think that's really a meaningful amount.
I mean, I know we talked about this in the past. Even I think we've done a podcast on this. You were always in favor. Will it take much more for pensions to put more money, or actually, do you worry that it'll have to be obligatory?
No, so this is something we're doing very much because it's in the best interest of our customers. So UK consumers have generally had poor returns on their pensions over the last decade, because basically they've allocated less to these private assets, these productive assets, compared to, for example, pensioners in Canada and Australia. And as a result of that, we think this is very much in the interests of our customers, and that's why it's a voluntary accord. You've had 17 different pension providers that account for 90% of the industry sign up to this today. We now need to get on and put this in place in practice.
What other measures are needed actually to boost the UK equity markets? Is there a way of reviving the City of London beyond this?
Beyond this, I mean, there are other reforms we've talked about. I think there's reforms in relation to stamp duty. There's reforms in relation to ISAs, these types of things that can be used. But I think one point just in relation to the Mansion House Accord that we've just talked about is that perhaps is something that gets missed. I've spent my time as as Lord Mayor. I've been going around the world speaking to a lot of the sovereign wealth funds. I've asked them, the United Kingdom is a remarkable place for them to invest. It ticks all the boxes in relation to sovereign wealth fund investment. Why isn't there more sovereign wealth fund investment here? And one of the reasons that's come up has been the lack of a number of domestic, large pension funds that are there, to be the lead investor in a lot of infrastructure projects, for instance. And the idea of now this, there are obviously some honourable exceptions. Phoenix is a good example of that. But this allows many more other pension funds to be these lead investors that will allow the sovereign wealth funds to crowd in behind, as an example.
Lord Mayor, how's the City of London doing overall? I mean, do you think, should the government consider, for example, reversing some of its non-dom crackdowns? Would that make a difference? What else do they need?
We're certainly having discussions in relation to taxation in general with the government, and there are some conversations going on. But I do sense that that there is confidence is coming back into the city. This is a good example now today. This is something that the pension funds weren't compelled to do, but there was a coming together of the industry wanting to do things in order to invest, not only in order to boost returns both on the private market side, AIM growth company side, but also into the United Kingdom. And I think that's a really strong signal.
Maybe if I could add to that. So I spent the week before last in the US talking to US investors about investing into Phoenix. And what was quite interesting is that they definitely have been overweight the US. They now see the UK as a much more stable, reliable, predictable environment in which to invest. And definitely are considering allocating more funds here. But that predictability and stability is really important. So having a stable regulatory environment, consistent policy over time is really important in terms of long-term investment.
Have a lot of pension funds already said that they'll now invest more in smaller listed companies?
Yeah, so that's basically what this accord is all about. And at Phoenix, one of the key things we've done is we set up a new asset manager called Future Growth Capital, focused very much on scale-up equity, so venture capital, private equity. We launched that in November of last year. We've committed to invest $2.5 billion over the first 3 years. We've already allocated since November the first $300 million into that. So this is now starting to get traction and get moving, and it'll be really beneficial for ordinary savers, which is the most important point.
Do you have an estimate of how many? Because you can pledge, but then actually not do it, or take your time to do it. So how?
Yeah. So
the size and scope of this.
Yeah, the estimate would be that there'll be 50 billion invested over the next 5 years to 2030 across the industry as a whole. That's the estimate, and that's what we now need to set about achieving. But it means we do need to get a flow of the right types of investments. We do need some regulatory changes in support of that. So today's a good step forward, but we now need to get into execution mode and bring those different aspects about.
What about, for example, getting rid of stamp duty for UK shares?
It's certainly something that we've been discussing with government, and that gives all sorts of opportunities there. And I think the government is listening, which is good to hear.
Yeah, and it does seem like things are moving in the right direction.
I think we've got certainly the Chancellor and also a number of the other Treasury ministers have expressed they're listening to what the City are saying, and I think that's extremely positive.
If you look at the 5%, could that go up to 8%? And we speak a lot about risk-taking, right? Once you start investing 5% in smaller companies, do you think that the risk appetite in general for UK investor changes?
Yes, so what the Accord says is we're going to invest up to 10% into private assets overall, of which at least 5% will be into the UK. I think there's every chance that it will be more than 5% in the UK, because ultimately when you're investing into private assets, you have less kind of knowledge and information around them that's readily available compared to public assets. And therefore, as a UK's largest pensions company, as Phoenix Group, the UK's largest pensions company, that there's a real attraction of investing in the UK because we understand the market that much better. So I think there's every chance that it would be more than 5% into the UK.
Does it feel good overall in the City of London? I mean, there was also this, a trade accord, trade agreement. Maybe let's not call it a deal between the US and the UK.
I certainly detect confidence coming back, which is excellent. So certainly hearing some of the investment programs that people have got, and also a number of following the dislocations in the world markets over the course of the last couple of months. London is such an attractive ecosystem for people to expand. So I think we'll see continued growth here over coming months.
Yeah, do you feel the same? It feels like there were good opportunities that were squandered in the past.
Yeah, so I'd say we're starting to make progress, but there's still a long way to go. If you look at UK stocks, they're still significantly undervalued compared to, for example, North American stocks. So I think we are doing a lot of the right things in the right way, but there's still an awful lot further to go to bring that about. I mean, just to build on the previous point on stamp duty, so what lots of countries do is they incentivise their savers to invest domestically. Our savers actually end up paying slightly more tax if they invest domestically than invest overseas. Yeah? So we're missing out on opportunities. There's still more that could be done to incentivise our own savers to invest more domestically, and also to make the UK ever more attractive for overseas capital to come and invest. And all of that is going to precipitate greater investment in the economy, greater economic growth, which again will be to the benefit of savers. If the economy is growing more, the returns on their investments will be higher, they'll be able to earn more and get a better retirement.
Where do you think on the priority list the City of London is for the government?
I think it's very high on the priority list because I think the government is absolutely spot on that success is going to come by driving economic growth. And the City of London is fundamental to that in terms of the capital that will support the infrastructure investments, the start-ups that will be central to delivering that growth. And
with the beautiful medallion, I mean, it reminds us also of the history, the beautiful history of the UK and the City of London. I mean, I don't have that on TV very often. Can you talk to us about it?
It's a badge of office. The original was an Elizabethan badge, which the office of Lord Mayor goes back to 1189, so 836 years of history there. But it has a very modern purpose, and that's to be the global ambassador for the United Kingdom's financial, professional, legal and maritime services. And I think this is a good example of the sort of thing that the Lord Mayor can hope to spearhead by bringing industry participants together for a common cause. And I think it's been great to work with so many of my colleagues in the pension funds, and there's been an enormous unanimity to get things done.
And history, I guess, matters, right? If you look at the rich history of the City of London,
absolutely.
I imagine it's a great story when you try and clinch that deal.
No, your history matters, but also, as Andy said, we're trusted and respected around the world. And I think in this time of fragmentation and division, the idea of having a trusted partner in the form of London and the United Kingdom, that goes an awful long way.
Okay, Andy and I feeling quite underdressed now.
Bereft without a medallion.
Alastair King, Lord Mayor of the City of London, Andy Briggs, Chief Executive Officer of Phoenix Group. Thank you both for joining us. Now, over onto the tech front, Google facing at least 12 billion euros worth of civil claims across the EU by dozens of price comparison websites. Now, Apple's looking at using AI to improve the iPhone's battery life. Let's get the details on both those stories with Bloomberg's Charlie Wells. Hi, Charlie.
Good morning, Francine. Now, the theme emerging in tech today really is this idea of transatlantic turbulence. So let's start with that 12 billion euro figure. That is the amount in damage claims that Bloomberg News has calculated Google faces from a constellation of websites, from price comparison websites, who allege that Google stole their customers. Now, these are lawsuits linked to a 2017 European Commission fine. They are bolstered by the findings of a tribunal from last year, and they span the continent. There are a number of lawsuits here. Now, Google has countered and said that these suits do not have merit. And actually, a lot of these plaintiffs face a difficult challenge in court because they would need to prove how Google's actions related to its own shopping business hurt their own profit. So this is a challenge for Google. Here in Europe, if you look on the other side of the Atlantic, we have news that Donald Trump called Apple's Tim Cook to talk about how he sees this company spending more than the $500 billion that they have already pledged to spend in the United States. This comes in the context of a lot of analysts on Wall Street and also consumers concerned about iPhone prices increasing next year significantly, as you can see in this chart right here. And it also comes at a time when that smartphone market is razor hot. You can see neck and neck Apple and Samsung really competing for that global market share in the handphone market. And it's no wonder in this context that we have some excellent Bloomberg News reporting showing that Apple is planning to roll out an AI feature that would help extend the life of its batteries, which is one of the main complaints that customers have about their iPhones.
Charlie, thank you so much. Charlie Wells there with the very latest, of course, on some of the tech companies. Coming up, as the U.S. president says, the EU is nastier than China when it comes to trade. We'll discuss the tariff outlook with the former Italian Prime Minister Matteo Renzi. That's next, and this is Bloomberg. Welcome back, everyone. Now let's return to the Saudi capital, Riyadh, where President Trump has arrived for the start of his Middle Eastern tour. Now, it's the first major international trip of his second term. Well, Bloomberg's Anne-Marie Hordern is there. Anne-Marie, so good to see you. So what's on Trump's agenda?
So right now, Francine, the president is sitting down for a lunch, and it's not just with the Crown Prince, his host once again for his first state visit, this time as 47th president. Remember, he made this trip in 2017 when he was the 45th president, really doubling down on the Middle East. So he's sitting down for lunch, but not just with the Crown Prince. They are being flanked by specific ministers and secretaries in their ministry, in their government, that are focused on things like defense and energy and commerce, think AI chips, as well as some tech titans and businessmen like the CEO of Qualcomm. This really underscores what the president is trying to do on this trip. He is not going to normal allies the way the United States would, traditional allies, say Canada or the United Kingdom. He's going to the Middle East. He wants to make sure he's coming back to the United States with transactions and deals in hand. And before he even set foot in Riyadh, he already inked $600 billion, a commitment from Riyadh, an investment into the United States, as well as more than $1 trillion from the UAE. And when you think about where this money is going, think of things like AI chip investments, critical for this region, as well as defense deals and potentially as well, Francine, some energy deals.
And Anne-Marie, President Trump's been joined by some top U.S. chief executives. We're hearing that then, of course, to have lunch with him and the Crown Prince will be Elon Musk, Sam Altman, and others. Are we expecting proper deals?
I think so, and I think at some point, if they're not proper deals, it's going to be outlines, commitments, or as the president may use the term, concepts of a deal. I think one thing to really focus on this trip is this idea of how this region and how states like Saudi Arabia, the UAE, Qatar can get access to advanced high-tech chips from the likes of NVIDIA. Because remember, under the Biden administration, there was this idea of a diffusion rule. It really broke up the world into tiers, into buckets. This administration decided to rescind that. It was supposed to come into play this week, May 15th. And these geopolitical swing states, where many people question what kind of access could China have to this tech, they are currently working that out right now in this administration. So the rules already loosened for these states like Saudi Arabia and UAE to get their hands on advanced technology. Right now, the discussion is about making sure that technology, Francine, does not leak to China. And that is going to be one of the biggest policy provisions that this administration is working on. And that this is something that the Gulf certainly wants to see.
Anne-Marie, thanks so much. Anne-Marie Herder there in Riyadh. Now, the U.S. Treasury Secretary has downplayed the possibility of a quick trade deal with the EU. Let's listen to Scott Bessent speaking at the Saudi-U.S. Investment Forum earlier.
Europe may have a collective action problem that the Italians want something that's different than the French. But I'm sure at the end of the day, we will reach a satisfactory conclusion.
Bessent's comments are the latest signal that the U.S. and Europe face a long road ahead on trade negotiations. Well, I could not be more delighted to be joined by Senator Matteo Renzi, a former Italian prime minister, and of course, head of the centrist party Italia Viva. Mr. Renzi, thank you for joining us. I mean, you hear Scott Bessent and you kind of think, well, he's not wrong. But then the president of the U.S. yesterday was calling Europe nasty.
Yes, it's true. Europe have a lot of tensions and troubles inside. But let me be very clear. All the chaos in the last 4 months come from USA. The responsible of the chaos is in White House because tariffs, trade war, tensions, particularly between United States of America and Europe, the best allies in the history, were created by White House. So that is the past. I hope we can solve the problem. I think it's very interesting, the trip of President Trump in Saudi, in Emirates, in Qatar. It's very important, the presence of CEOs, America, at the lunch with Crown Prince MBS. That is also a success for MBS to host all the CEOs in the Vision 2030, the project for the future of Saudi Arabia. About Europe, it's true, there is difference between France and Italy, but the answer of Europe to the attack of USA was a good answer, and I hope we arrive a good deal. Yesterday, a very good signal from China, and hopefully also in the relation between EU and USA. World needs relax, peace and dialogue, not chaos.
I agree. We could all do with a bit of relaxing, Mr. Renzi. But how should Europe deal with China? Again, the U.S. and China were at loggerheads, and suddenly they seem, much more friendly. In fact, you could argue the U.S. gave the Chinese a better deal than they did the U.K.
Francine, it's not clear for the politicians to understand what is the strategy of President Trump, because if we discuss in the next 10 years, we are sure China will be the worst problem for USA, particularly in artificial intelligence, in innovation. And in theory, the strategy of President Trump have to be to create an alliance to defend from the China's investment in the future. But if he continues to have tensions with Russia, Russia and China will work together for energy, and that will be a problem for USA. And particularly, if Trump will closed an agreement with China, and for the moment not with Europe, that it's a little strange. So I think the priority for us is to check what could happen between China and USA, but focus on the deal between EU and USA. There is other problem. There is one more thing: is Europe have to wake up. Europe have to stop with this terrible red tape of bureaucracy, and Europe have to come back to be a place of innovation too. Not easy, but we have to try.
But they also, we understand that President Trump likes this, the one-on-one, the conversations. Who's the right person for this? Is it Giorgia Meloni? We know that she's close to President Trump, but then does that mean that she's retrenching from some of her European duties?
But I think Donald Trump speaks with everyone. That is very, very nice in terms of human relation, because he used to say Giorgia Meloni, she's fantastic. He used to say Ursula von der Leyen, she's fantastic. Emmanuel Macron, for him, did a great job. Keir Starmer will come back in the not in Europe, but in a very important position, is a very great man. He used very nice words for everyone. The real question is, Europe have to be less bureaucratic, and at the same time it's important to check, this is my prediction, what could change in Germany. Because the new chancellor Friedrich Merz. He started with some problems in the first votation, but there is not Europe without Germany. And I think Friedrich Merz will be the next leader in Europe. In my humble opinion about Giorgia Meloni, she's very good in terms of empathy and relation, but she lost the momentum. She had a great opportunity 6 months ago with the crisis of Germany, with the crisis of France. She lost the momentum also because she used to change with the wind. She was with Putin in 2015, and now she's with Zelensky. She was pro-Biden, and now she's pro-Trump. She was against Euro, she pro-Euro. So Georgia, she's my prime minister. She's not my party, but I respect her. But she's a woman without a strategy. She followed the day-by-day events. She's more an influencer than a stateswoman.
I mean, critics to that would say actually she's done an okay job, and since becoming into power, she has supported Ukraine. So were you disappointed that she wasn't on that train, bringing the leaders to see Zelensky in Kyiv this week? Because she's very right wing, but she kept the economy on an okay path.
Okay, I think about Ukraine. She lost the opportunity to stay on the train, not because it was important the train, but because the train was the symbol of the European unity, exactly waiting and working for an agreement. I think we have to do an agreement with Russia, with Putin and Zelensky, and I hope next, in this week, we will have a very important meeting in Istanbul or where they decide. But she was the woman who supported Putin before, then who supported Zelensky. The decision to get off from the train have two problems. The first, she gave her place to Poland. Now, in the picture, there is Germany, France, and Poland. And that is also the strategy of Chancellor Merz. And the second, she lost her credibility because she cannot change every time following the events. That is a big problem for Georgia. For Europe, I think we have to stay with Ukraine, try to do the agreement, and then also to react to the decision of President Trump. For example, just one little example. If we will try to call researchers, doctors, students from the United States of America with fiscal incentives, that is good. After Brexit, I signed an agreement to attract rich people from London to Milano. Today, Milano is full of rich people. Roma, also other cities in Italy, because I signed this law to attract rich people. We have to attract now young talents and the students and doctors from the United States of America.
I mean, our societies are being splintered. There's a rise of the right. There's Ukraine. There's China. There's the U.S. What's your number one concern that Europe has to get right in the next 6 months?
It's strange because my first preoccupation is not, of course, we are very worried for Ukraine, for Holy Land, for all the wars, India, Pakistan, Sudan, for China, for tariffs. But my preoccupation for Europe is the decline of demography. It's not a day-by-day question, but we lost an incredible number of people. Only in Italy, in 50 years, we have 1/3 of the new babies. So if Europe, we don't attract young and come back to have a change in demography, Europe risks to decline.
Okay, thank you so much. Well, you have to come back and talk a little bit more about this. Just a bit of a curveball talking about demography. The former Italian Prime Minister and head of the Italia Viva party, Matteo Renzi. I think we'll go back to Riyadh because we're also expecting Donald Trump to speak very shortly. You can see these are some of the live pictures there from the Saudi capital. Up next, a Bloomberg Brief, and this is Bloomberg.